Welcome to the deep dive. Today we're doing something pretty focused.
Right.
We're cutting straight through the usual earnings call noise from Goldman Sachs's Q3 2025.
Yeah, skipping the broader stuff for now.
Exactly. We are zeroing in just on the financial performance summary, the numbers, the core metrics as delivered by the CFO, Dennis Coleman.
Purely quantitative. We're really digging into how the firm actually performed this quarter, based on what he presented.
Okay, so let's get straight to it. The top line numbers looked, well, strong.
Very solid.
Net revenues, $15.2 billion.
Yep.
Earnings per share, EPS, $12.25.
$4.25. Quite a figure.
And profitability. Return on equity, ROE, came in at 14.2%.
14.2. But they also gave another number, return on operations, or RO.
Right, 15.2%. Why flag both? Isn't ROE the standard?
It is, but well, it gives you a slightly different angle. It's profitability before you factor in financial leverage costs.
Yeah.
It's a cleaner look at the core operating businesses.
Okay. So that 15.2% really speaks to the efficiency of their main activities.
Precisely.
Yeah.
It suggests those internal efficiency drives they've been talking about are, actually hitting the bottom line now. Looks quite good compared to history and their peers, too.
Got it. Impressive start then. But that $15.2 billion, where did it actually come from? You almost have to start with global banking and markets, right? GBM?
Absolutely. GBM was the clear powerhouse this quarter. $10.1 billion in revenue.
10.1, just from GBM.
Yeah. Think of that. It's basically 2/3 of the firm's total revenue. Shows you how central that division still is.
Wow. And the profitability there.
Year-to-date ROE for GBM was 17%.
17%. That's huge. But doesn't that also highlight maybe a reliance on a pretty cyclical business? Is that a risk?
Well, that's always the question, isn't it? Tension. But the CFO pointed to some specific things, suggesting this strength might be more, let's say, structural this time.
Like what?
Like investment banking advisory. That was the real standout within GBM.
Okay. What were the numbers there?
Advisory revenues hit $1.44 billion.
1.44. Hang on. The notes say that's up 60% year over year. 60.
Massive jump. Yeah. And importantly, it wasn't just better pricing. It was driven by a big increase in deal completions.
So deals actually crossing the finish line? Stuff that was maybe waiting in the pipeline?
Exactly. The volume was finally realized. And, Goldman's still number one. They hold that top ranked globally in announced and completed M&A. Same story across the Americas, EMEA, and APAC. Just dominant.
Okay, so M&A advisory is booming. Does that usually pull other things along with it, like underwriting?
Typically, yes, and we saw that. The recovery was pretty clear across capital markets. Equity underwriting revenues were $465 million.
Up 21% year over year. That sounds like IPOs coming back.
Directly linked. Yeah, the IPO market thawed out. They mentioned some big ones they priced, CLA, Figma, Figure Technology.
Right, I saw those names. After such a long dry spell, that must feel like a significant boost.
Definitely. And debt underwriting wasn't far behind. Net underwriting revenues hit $788 million.
Which was up 30%?
30%, yeah. Reflecting more leverage activity. Companies feeling more confident borrowing again. And Goldman's strong there, too. Number 2 rank in high-yield debt and leverage lending.
Okay, here's something that really caught my eye about the backlog.
Yeah.
Even after closing all those deals, their quarter-end backlog is apparently the highest it's been in 3 years.
That's a really key point. It suggests this isn't just a one-quarter spike. They executed well, and the pipeline for the next few quarters looks really strong. Sustained momentum.
So client confidence seems to be back, at least for Goldman's clients.
Looks that way. Okay, so that's the traditional banking side. Let's pivot a bit to the markets businesses.
Yep.
FIC and equities, trading and financing.
How did markets do? Still strong?
Showed good resilience, yeah.
Yeah.
FIC, that's fixed income, currencies, commodities, brought in $3.5 billion in net revenue.
Which was up 17% year over year.
17%, yes. Driven mostly by rates, mortgages, and commodities. Currencies and credit were a bit softer, offsetting some of that gain.
Equities.
Equities net revenues were $3.7 billion total. But the really interesting story within markets, I think, is financing.
Financing, as opposed to just trading.
Exactly. This is becoming a much bigger deal for them. Historically, markets revenue could swing wildly with trading results, but now financing revenues across both FIC and equities hit $2.88 billion this quarter.
Wait, almost $3 billion just from financing activities. How big is that overall?
It's getting quite significant, up 23% year over year. And the CFO made a point of saying financing is now nearly 40% of the total FIC and equities revenue.
40%, wow.
Yeah, it's a deliberate strategy, swapping out some of that volatile trading income for more durable, fee-based revenue tied to client activity and balances.
Makes sense. More predictable. And where's that financing growth strongest?
Equities financing. That part alone was a record $1.7 billion.
Record 1.7, up 33% year over year.
33%, driven by record average prime balances. So basically, their big clients, hedge funds, institutions are borrowing more, using Goldman's balance sheet more, and that generates steady fees.
Okay, that focus on durable, stable fees, that leads us right into asset and wealth management, doesn't it? AWM.
Exactly. That's the other key growth engine for them long term.
And AWM put up $4.4 billion in revenue for the quarter.
Solid number.
And again, that theme of durability, management, and other fees, this is nice recurring fees, hit a record $2.9 billion.
Up 12% year over year. That's what you call high-quality revenue.
Definitely. And if you add in private banking and lending revenue?
Right. You get their total durable revenues. That hit a record $4 billion just in Q3. Year to date, that's $11 billion in durable revenue from AWM. It really shows that strategy of gathering those sticky assets is working.
It seems to be. Assets under supervision AUS ended at a record $3.5 trillion.
$3.5 trillion.
And get this, it was the 31st consecutive quarter of long-term fee-based net inflows.
31 quarters straight. That's incredible consistency. How much came in this quarter?
$56 billion in inflows this quarter alone. That kind of streak really speaks to client trust, doesn't it?
It absolutely does. And they're not just gathering traditional assets. They're also killing it in alternatives fundraising.
Ah, right, the private market stuff.
Yeah. Gross third-party fundraising hit a record $33 billion in Q3.
$33 billion in one quarter.
Yep. Brings the year-to-date total to $70 billion, mostly private equity, private credit strategies. Investors clearly want that exposure, and Goldman's capturing it.
Now, there was a nuance you mentioned earlier about AWM's profitability. The reported numbers were 23% pre-tax margin and 10.5% ROE year-to-date.
Right.
But the CFO added a comment about something called HPI, said the numbers would be quite a bit higher without it.
Yeah, HPI stands for Hedge Fund Principal Investments. Basically, legacy positions, sort of historical investments that are more volatile. So by saying, look, if you exclude HPI, the margin's actually 150 basis points higher, and the ROE is 250 basis points higher, he's signaling to investors.
Signaling what? Exactly.
He's basically saying the underlying core AWM business, the part we're focusing on growing, is actually much more profitable than the headline number suggests once you strip out these older, lumpier bits we're trying to wind down. It paints a better picture of the future run rate.
Okay, that makes a lot more sense. Good clarification. Right, let's shift to the operational side. Expenses, credit quality, capital. What was the story on net interest income?
Firm-wide NII was $3.9 billion. That's supporting a pretty chunky loan portfolio, about $222 billion total.
And credit provisions, any warning signs there?
Provision for credit losses was $339 million. The CFO was quite clear this was mostly driven by net charge-offs in their credit card portfolio.
So consumer credit related, which isn't totally unexpected in that space.
Pretty much standard for that business line, yeah.
Okay, what about costs? Operating expenses were $9.5 billion total. How do they manage the compensation line with revenue so strong?
Well, the strong revenue actually helped efficiency there. The year-to-date comp ratio estimate is now 32.5%.
32.5. And that's better than before.
Yeah, it's a 100 basis point improvement compared to last year's run rate. Basically, higher revenues mean they can afford the necessary compensation while still improving the ratio overall.
But non-compensation expenses jumped up, didn't they? $4.8 billion, up 14% year over year. That sounds like a lot.
It is a noticeable jump, but you have to look at why. The main driver was higher transaction-based costs.
Meaning
the costs associated with executing all those M&A deals and underwriting activities we talked about. Brokerage, clearing, exchange fees. It's a cost that goes up when business is booming.
Okay, so it's kind of a good cost to have in a way.
Largely, yes. The other drivers were some litigation expenses and also charitable contributions. They noted they're spreading out the timing of giving this year, not bunching it all in Q4. So, yeah, the rise largely confirms high activity levels.
Got it. Paying more because you're doing more business. Makes sense. Okay, finally, let's wrap with capital. How much went back to shareholders?
A lot. $3.3 billion returned just this quarter.
$3 billion? How?
It was $1.3 billion in dividends and another $2 billion in share buybacks.
Significant return. And the balance sheet strength, how does that look?
Rock solid. The key metric here is the Common Equity Tier 1 ratio, the CET1 ratio.
And where did that land?
Under the standardized approach, it ended Q3 at 14.4%.
14.4. And what's the requirement?
The regulatory minimum for them is 10.9%.
Wow, so they're way above that. That's a huge buffer.
Huge buffer, yeah. Not just meeting the rules, but significantly exceeding them.
Okay, so if we step back and look at everything the CFO laid out, what's the big picture takeaway here?
I think it's really about powerful momentum. You've got this incredibly profitable core business firing on all cylinders, especially M&A, where they're just dominant.
Right.
You've got clear success in making the markets business more durable through financing. And AWM is just consistently growing those stable fees. So the picture painted is one of accelerating profitability and, importantly, substantial excess capital.
Which brings us perfectly to that final thought for you, the listener, to chew on.
Mm-hmm.
Given that massive capital cushion, that 14.4% CET1 versus a 10.9% requirement, that's over 350 basis points of excess.
That's a lot of firepower.
Exactly. And the CFO talking about efficiency gains allowing them to go on offense, what do they do next? With that kind of financial capacity, what strategic opportunities might they pursue? Big acquisitions, new ventures? Just pour even more back to shareholders.
That excess capital isn't just a safety net, is it? It's a potential energy, strategic potential.
Definitely something to watch. A great question to think about as this story unfolds.
Absolutely, lots to consider there.
Well, thank you for diving deep with us into just the CFO's slice of the Goldman Q3 results.
My pleasure. Always interesting to dig into the numbers.
We'll catch you on the next Dupe Dive.